Task. Good morning, everybody. Thank you for coming to Green Bee Advisory and SMB Financial Strategies, our partners, great partner firm, power team, all women. We host a monthly Women in STEM networking group, and the goal really is to support women because as you know, one of us rises, we're all rising together. And we find also that women tend to invest in solutions and products that make the world a better place. So that makes us happy. So thank you for coming. Today we're talking about equity compensation, specifically for women in STEM, but really if you have equity compensation, right, this applies equally. My background, I started on Wall Street. I worked for a firm called Lehman Brothers, if anybody has heard of that. And fast forward, though, a couple decades, and I started. There were 25% women, and there's still 25% women in financial services. Nothing really has changed. So we like to say we're no jargon and no mansplaining here, right? Focus on female financial empowerment. My business, Sarin, helps everybody. And we are always happy to help you, but I like to focus on women. I have 4 daughters, so I'm very much a proponent of owning your financial future. And then personally, I am outdoorsy and just a little bit competitive. So today, the highlights, we're going to talk about the basics. What is equity compensation? Types of equity compensation, some of the challenges that surround equity comp, opportunities, and then our options for planning. So starting with the basics, what exactly is equity compensation? How does it work? And some of the common terminology. So equity compensation is a form of compensation that is meant to incentivize you and reward you for your service. And it gives companies the ability to attract employees and retain them. How does it work? So you are granted shares or options. The shares or options vest, which means that is when they become available to you. So it starts as a promise, and then upon vesting, then you have the ability to do something with it. We'll explain a little bit further. And then once you're fully vested, you have the control over those shares or options. So the first thing that we need as financial planners is your option grant document. And not everybody knows really what this is, because what happens is companies either sort of tell you, or it may show up somehow in your online account. But as a financial planner, we always want to go back to the actual grant document. And some of the things that we will see on that grant document is the number of shares granted, the type of either stock or options that were granted, the purchase price or strike price, in particular if we're talking about incentive stock options. We also have the grant date, and then the vesting schedule. And the vesting schedule, often we see quarterly, sometimes it's annually. And then if it's incentive stock options, there's also an expiration date that you want to pay attention to. So there are many types of equity compensation.
Can you guys see the TV better?
Yeah.
There's a lot of different types of equity compensation. I put RSUs, restricted stock units, on the top because this is really what we're seeing more of now. 10 years ago, it would have been incentive stock options, what we're seeing. We also have non-qualified stock options. We have stock appreciation rights. And then sometimes clients have access to employee stock purchase plan, which is kind of a mini version light. So what are some of the challenges surrounding equity compensation? First of all, your decision timelines vary. And again, going back to that grant document, paying attention to vesting schedules, possible expirations. So every grant is different. And you could have multiple grants from the same company that have different guidelines attached to them. So let's talk a little bit about how vesting works, right? So this is a very basic example. You were granted 300 shares initially in that grant, right? So on day 0, the grant or the promise is 300 shares. And this vesting schedule is every year, you're going to get a third of that, right? So on year 1, so between 0 and 1, there's nothing really for you. So you have to stay with the company at least for the first year. And then 100 shares become accessible to you, right? If you stay with the company the second year, next 100, and the third year 100. And what's happening is the longer you stay with the firm, usually they're offering, like year 1, you'll have another set. So your schedule and timeline kind of continues to push out. And the reason the companies do that is they want you to stay. And the vesting schedule you can vest either based on time or event based. And I have seen that where, and a recent example was a client who works in biotech, and she had a combination of options. One combination was just time based, and it was like, okay, you're great, you're there, you're happy, you're going to stay there, we know we're going to have something to work with. But the other grant doc had kind of this esoteric performance-based vesting schedule that to me was a little bit less exciting because a million things could happen with the performance of the company, right? It didn't directly pertain to her and her time and her longevity at the company. But that does exist, so you really do want to pay attention to how your particular vesting schedule works. All right, this slide really is meant to show you the complexity of stock options. This is an incentive stock option example, and all the different times in the life cycle of that stock option grant that something may impact your financial life. So we have a grant time 0, and let's say the first vesting period happens after a year. So now we have vested. So we have a couple shares that have vested that we're going to figure out whether it makes sense if we're going to exercise these shares or not. If the stock price is above the exercise price, which is dictated in that grant document, then we may consider exercising. Doesn't mean we do, because those shares are considered in the money, right? Because if we can exercise here and sell here, we might make a little bit of money. So that's the first decision timeline here, right here at vest. The second decision, so now we're year 2, if we have exercised, now we're going to look at the tax implications of our exercising of this grant. And incentive stock options, the exercise is going to determine whether it's a qualifying exercise or a disqualifying exercise. And the tax ramifications depend on whether it was qualifying or disqualifying. So in essence, this is meant to show you that we have all kinds of potential tax ramifications, whether we made it a qualifying disposition, disqualifying disposition. We may have AMT, alternative minimum tax, to pay. We may be taxed at ordinary income rates. We may be taxed at short-term cap gains rates or even long-term cap gains rates. So incentive stock options are really very complex to manage. And don't forget, what's happening is we have a grant, we have vesting, and then the next year we might have another grant and another vesting schedule. So in order to stay on top of them is very, very complex. So that's incentive stock options. Restricted stock units are a little bit easier to manage, and that's what we're seeing more of these days. So with restricted stock, when you are granted that stock grant, the RSU grant, there's no taxes. You received really kind of a promise. Then what happens is upon your first vesting schedule, you are taxed on the value of that stock. You actually receive the stock and you are taxed on it. And typically, you are withheld, the taxes are withheld at a 22% tax rate. The problem with that is a lot of us are in higher tax brackets. And probably 99% of the world of RSU owners really has no idea that this is sort of what's happening, that the default is 22%. They think they're good. And then what happens come tax time is all of a sudden it's like, well, you're actually in the 37% tax bracket, but we only withheld at 22. So you owe us $50,000. Now what happens? You have to come up with that money. So this default sell to cover tax rate is very often way too low. Okay, so then we have the second potential tax event. So we received the shares. If we sell those shares prior to 1 year time horizon, we're going to owe taxes, additional taxes, short-term capital gains, and I'm going to show you those rates. But if we hold them for longer than a year, so and 2 years from the actual vest, then it's going to be long-term cap gains rates. Okay, so even though RSUs are easier to understand than incentive stock options, it's still super complex. So what I want to show you, the short-term cap rates for 2025 are the same as income tax rates. Okay, so short-term cap gains, income tax rates. So if you're at, a 35% tax bracket, you make over $501,050. Again, 35% tax bracket. Okay, so think back to on the RSUs, we were withheld at 22%, but we're here because we're married, filing jointly, and together we make over $500,000. Whereas the long-term cap gains rates are much lower. So again, we have, those two separate time horizons. We have the RSU taxes being withheld at 22%. Then we have, are we going to hold the stock? Are we going to sell it? And there's all kinds of decisions that go into that. It's not just the taxes. Is the stock doing really well? We want to hold on to it because we're going to earn more. Do we need the cash? Where does that fit into our financial planning? But you can see here in the long-term cap gains rates, I can make more than $600,000 and I'm only paying 20%. So there are a lot of decisions that go into managing your equity compensation. There's also a lot of opportunities. So a lot of what we like to talk about, certainly for our women out in the executive workforce, is when you are negotiating your initial compensation package, don't forget to negotiate your equity compensation. You can negotiate this. It's not just the salary, it's also the equity compensation. You want to ask about the vesting schedule and you want to agree on the vesting schedule. You want to get written agreements, and you also want to pay attention to any strings. So there can be strings involved in those equity grants. What happens if I get divorced? What happens if I leave the company? So you want to know these things, and it's your right to inquire and to negotiate your equity compensation. Oh, yeah, sure.
What parts of the equity compensation are negotiable? It's just the number of shares.
No, and I mean, you ask about all of it. So going back to, right, the number of shares, the vesting schedule. I talked about some of the vestings are performance-based. Can we transfer those to time-based, right? Like, I don't really have any control over the performance-based for the whole company. So ask about all of it. I mean, they'll push back or not, but don't forget to negotiate equity compensation. That's really the important piece. It's not just your salary. So again, you also want to know about what happens, again, if there's like death, disability, or divorce. If your partner has equity compensation, the same thing. You want to understand what happens. We want to work on a process for managing your equity compensation. And then you also incorporate, we're financial planners here at Greenbee and SMB Financial Strategies. Like, we manage your equity compensation as part of your overall financial plan and your goals. So I want to show you, so we use a financial planning software that allows us to manage in a very precise fashion your equity compensation. So when you come to us with equity compensation, we ask you for the grant docs, and then that helps us program into our system what are the underlying grants, the lots, the strategy that we'll talk about. So this is just an example. We have 2 grants of restricted stock, grant 1 and 2, and within each of these grants, then we've programmed out the vesting schedules and what happens. So this is just very like the tip of the iceberg on some of what we can help you do in planning for your equity compensation, that we can run out these activity forecasts where we will say we're going to exercise, so we have net proceeds over here, and then what is the potential income tax on that? And this is important, right? Because if I wind up with 45,000 instead of 91, that's going to impact whether I can, pay for my daughter's education, or we can make that vacation, or put more in our retirement funds, etc. So this is just very tip of the iceberg, why you want to understand not only your grants, but also the timeline of all of the decisions. So really, in summary, we want to make sure that we are advocating for our salaries and our equity compensation. You want to understand your grants. I mean, this world of equity compensation is so complex, and every grant doc is different. Even depending at the same company, can be very different. You want to control it, manage it. We want to manage the tax implications. We also want to talk about diversification, because sometimes clients come and they're concentrated. They have corporate risk because they work at the company. Then we have stock concentration risk because we're receiving a lot of this stock. So that's where, we're going to help you diversify out so that it's appropriate for your entire portfolio. And then invest with confidence. I always like to say this, especially for our women investors. Like, I want you being an aggressive investor. Let's invest in stock in an appropriate fashion based on our time horizon and age, but let's not miss out on stock market opportunities. So thank you for coming. We can take questions now if anybody has any.